Welcome back to the deep dive. You know the drill by now. We take your sources, the articles, the research, the data you send us, and we really drill down past the headlines to get to the knowledge that, well, that truly matters. And today we are tackling a concept that is both deeply, deeply personal and at the same time globally significant. Consumer debt.
It really is. It's a term we hear constantly, right? In the news and political debates, but it's often it's misused or just lumped in with government borrowing or even corporate debt.
Yeah, they're all just debt.
They're all just debt. And I think most people feel the immediate, the stressful effects of their own consumer debt, but very few of us stop to appreciate how fundamentally different it is from other kinds of borrowing, or just how massive its macroeconomic role has become.
That's exactly the mission for this deep dive. We are going to unpack what consumer debt actually is, why it matters so much to macroeconomics. So not just to your personal budget, but to the actual functioning of entire economies. And then we'll get into the numbers. We're going to look at what they actually look like when we compare these private debt burdens across the globe using the really detailed data you shared with us.
Yeah.
And that includes those fascinating debt to GDP ratios that go back decades.
And we absolutely must, I think, introduce the core distinction right away. This is the lens through which every economist looks at this topic.
Okay.
Consumer debt is fundamentally different because it funds consumption rather than investment.
Yeah.
It's a crucial separation that defines its entire risk profile and, its economic utility.
That idea of funding consumption versus investment, that feels like the real dividing line here, doesn't it?
Yeah.
It separates a loan that, in theory, creates future value from a loan that just enables immediate gratification.
Precisely. I mean, when we talk about debt in the context of economic growth, investment is generally the hero of the story. Investment debt finances things like, new factories or research and development infrastructure things that are supposed to generate future income streams. Consumer debt, by contrast, is debt you take on for goods that are consumable. They don't appreciate in value. It's money used to fund immediate needs or desires without any expected financial return.
So we're going to explore why taking on debt for, say, a big screen television right now is traditionally seen as, well, not a great financial move. But we're not just stopping there. We have a really fascinating alternative view in the source material that suggests consumer debt isn't just a necessary evil, but that it actually plays this crucial positive role. It fuels overall domestic production and allows people to manage their lives better.
It's a very complex, dynamic discussion.
It is. And we're going to make sure that by the end of this, you walk away with a crystal clear understanding of both sides of that argument.
Okay.
Let's unpack this, starting with the formal definition. So at its simplest, consumer debt is the amount owed specifically by individual consumers. This sounds really basic, but it's a vital filter.
It really is.
We are specifically separating this money from, the massive tabs held by governments, or the really complex liabilities carried by major corporations. We are focused squarely on the personal balance sheet, just aggregated up across the whole nation.
Right. And while household debt often includes mortgages, which are, let's be honest, typically the largest chunk of an individual's liabilities, the term consumer debt often focuses more specifically on the unsecured, shorter-term loans taken out for non-housing purposes.
Okay, so you're pulling mortgages out of this specific bucket for a second.
For a moment, yeah. Because while mortgages are technically owed by consumers, their purpose is secured investment in a dwelling, which, it complicates that whole consumption versus investment debate we just had. For macroeconomists studying consumption patterns, the key distinction is always the purpose of the money.
Is it funding immediate consumption, or is it funding long-term capital formation?
That's the question.
And when we look at the source material, the most common, high visibility forms of consumer debt are things we all recognize instantly. We're talking about the products that fill every junk mailbox and every online ad.
Oh, yeah.
Credit card debt, those quick fix payday loans, student loans, and then all the other various forms of general consumer finance, like personal loans or, retail store financing.
These are the tools that grease the wheels of immediate demand. They allow us to acquire goods and services right now instead of waiting until we have the savings. But the high price for that convenience is really what elevates the risk.
And these specific forms of debt, especially credit cards and payday loans, they come with significantly higher interest rates than long-term secured loans, like a mortgage or, say, a well-collateralized commercial loan.
Massively higher.
So if the underlying economic principle here is that debt should ideally fund something that provides a return, or at the very least holds its value, what does that high cost of interest do to the overall financial equation for a consumer good?
Well, it makes the financial consequences of accumulating that consumer debt vastly more pronounced. I mean, say you buy a $1,000 laptop on a credit card at, let's say, 25% APR.
Which isn't an uncommon rate.
Not at all. If you only make the minimum payments, you might end up paying $1,500 or even more over 3 or 4 years. And for what? For an item that is functionally obsolete after maybe 2 years.
Wow.
You are paying a huge premium for the mere timing of the acquisition. The cost of financing easily outstrips the rate of depreciation, making the debt fundamentally corrosive to building long-term wealth.
That sets the stage perfectly for a necessary sidebar we have to take.
Yeah.
We need to clarify the different categories of debt instruments and management practices that are highlighted in the source material because, as we've just said, not all debt is created equal.
Not even close.
Especially when you consider the risk the lender is carrying and, of course, the cost the borrower has to bear.
Yeah, let's start with the most common and often the riskiest category, unsecured debt.
This is what you often hear called a signature loan, right? It's debt based purely on the consumer's promise to repay, with no specific collateral tied to the loan itself.
Precisely. This is the heavy hitter in the high-risk, high-interest consumer space. It starts with the absolute most common form, credit card debt, which gives you that revolving line of credit.
And then you have cash advances, which are basically super high fee, high interest withdrawals from that same line of credit, and then overdraft facilities on your bank account.
Yeah.
We also have to mention the particularly contentious areas like payday loans. The source material really highlights them as being highly controversial.
They are, and for good reason. Payday loans are structured to be very short-term, small-amount loans. They're often designed to just tide someone over until their next paycheck.
In theory.
In theory. But the fees and the associated interest rates, when you actually annualize them, can be extraordinarily high. I mean, we're often talking triple digits.
Hundreds of percent APR.
Exactly. They are frequently criticized, as the sources note, for trapping economically vulnerable borrowers in these cycles of perpetual debt. You're just constantly renewing the loan, and the fees become more burdensome than the original principal ever was.
And of course, general personal loans fall in here too, including things like microcredit, which is just smaller scale lending. But in all these unsecured cases, if the consumer defaults, the lender is in a really tough spot.
They are. Their recourse is limited to collections actions and, damaging the consumer's credit rating. They don't have a physical asset they can just go seize and liquidate.
Now, you contrast that with the other category, secured debt.
Right. And here, the risk profile for the lender changes completely. This is borrowing that requires the consumer to put up collateral, an asset the lender can take and sell if the borrower defaults.
The prime example, of course, is the mortgage, where the house itself secures the loan. The sources also mention home equity loans, or remortgaging, where you use your existing home value as collateral to pull out cash, usually at a much lower rate than a credit card.
But secured debt exists heavily in the core consumer sector, too. A prime example highlighted in the material is the car title loan, or a logbook loan. These are loans where you use your vehicle's title as collateral.
And these loans present a particularly sharp risk for the borrower, don't they? If you fail to repay, you lose your mode of transportation.
Which can immediately compromise your ability to even get to work, to earn an income.
Exactly. It triggers this horrible negative feedback loop.
Absolutely. They are often very high-risk loans for people who have few other options available to them. And let's not forget tax refund anticipation loans.
They sound so harmless.
They do, but they are short-term loans secured by the expectation of a future tax refund. They are a very high-cost way to access money that is essentially already owed to you by the government. You're just leveraging your immediate need for cash.
So understanding this risk structure, unsecured versus secured, it's fundamental. But if we pull back to the macroeconomic level, why does a country having a lot of unsecured high-cost debt carry more systemic risk than, say, a lot of secured mortgage debt?
That's a crucial question. I mean, mortgage debt, while it's massive, is secured by an asset that usually requires an appraisal. It suggests a degree of underlying value.
Although we all know secured debt can fuel asset bubbles. We saw that in 2008.
We certainly did. But unsecured consumer debt, by its very nature, is funding immediate consumption that just vanishes. It is often invisible to other parts of the financial system until it actually defaults. If millions of consumers suddenly start paying their credit cards and personal loans all at once,
The resulting shockwaves of write-offs and defaults would hit the banking system directly without any offsetting asset they can recover.
it's a pure, unmitigated loss driven by a downturn in consumer solvency. This high-risk debt really acts like a barometer for the immediate financial health of the working population.
So that brings us to the big picture, the economic and personal implications of all this consumer debt. We've established that this kind of debt, especially the unsecured high-interest kind, is fundamentally used for non-appreciating consumption.
And that takes us straight to the traditional dominant view in finance, which is, why is accumulating long-term consumer debt considered fiscally suboptimal?
Right. The core argument, as you laid out before, is just simple arithmetic. It's driven by depreciation and interest.
Exactly. The source material really emphasizes that most consumer goods, from the latest smart device to a new sofa, they do not appreciate. They lose value rapidly, sometimes the moment they leave the store.
And when you couple this rapid depreciation with the high interest cost you pay to acquire the item early, the transaction becomes financially draining.
It does. The value lost to interest and depreciation usually cannot be financially justified by the subjective benefit of just enjoying the item right now.
The specific example given in the material, the big screen television, is perfect for this. If the television depreciates by, say, 30% in a year, and you're paying 20% interest on the debt,
You have lost 50% of the financial value in just 12 months. All for what? To watch the latest streaming services slightly earlier?
that's the reality for many consumers. The cost of financing vastly outweighs the utility they get, especially when that financing carries those high rates. And for the individual consumer, these are not abstract numbers. The real-world consequences are immediate and often quite severe.
Yeah.
We see the clear evidence of this in the rise of specialized financial services. We're talking about the absolute explosion of the debt consolidation industry and the credit counseling sector.
These industries exist fundamentally because individuals have accumulated this revolving debt beyond their reasonable means to repay it. The typical client for a credit counselor is someone who's spending far more than the recommended 20% of their take-home pay, simply servicing interest and minimum payments.
And when debt service consumes that huge a proportion of your disposable income, it severely restricts your economic mobility. It makes the household extraordinarily vulnerable to any small financial shock, like a car repair or a medical bill.
Oh, absolutely. And the effects are quantifiable and non-quantifiable. Tangibly, you get the inevitable lower credit score, which is a massive, massive disadvantage in today's world.
And a lower credit score is just a vicious cycle.
It is. It means you're perceived as a higher risk, which means future borrowing, like for a mortgage or a car loan, will be offered at higher rates, if at all. You are penalized for your past debt by having to pay a premium on any future necessary debt, making it harder and harder to break free.
And then intangibly, the source material notes the critical potential effects on mental health.
Yes. Financial distress, often centered on what feels like insurmountable debt, is a huge burden. It leads to anxiety, depression, and just incredible strain on personal relationships.
This all paints a very, very bleak picture. It's just consumer debt is a drain on personal wealth and potentially an amplifier of financial instability.
Yeah.
But here's where it gets really interesting. Because macroeconomic thought presents a much more sophisticated alternative perspective.
Right.
If consumer debt is so suboptimal for the individual, why is it such a massive integral feature of every major developed economy?
That's the critical question we have to ask. If we connect this to the broader picture, many economists argue that consumer debt is not merely a personal failing or a drain on the system. It is a massive, and I would say necessary, driver of economic activity, particularly in economies built on consumer spending, like the United States and the UK.
Okay, let's break down that alternative analysis, starting with argument 1, increased domestic production.
This analysis fundamentally treats debt as a mechanism for immediate, large-scale demand creation. If credit is readily available, consumers can borrow quickly and easily to buy goods, appliances, cars, clothing, and services. This injection of immediate purchasing power drastically increases the overall demand for those consumer goods.
And what happens when demand increases that rapidly?
Well, that increased demand signals manufacturers and retailers to ramp up production and stock levels. This causes an increase in overall domestic production, which means job creation and general economic turnover.
So in this light, that high-interest TV purchase isn't just a personal folly.
Exactly. It's the necessary, consistent demand signal that keeps factories operating at capacity and the national economy humming. Debt, therefore, functions as a powerful form of economic fuel.
That dramatically reframes the issue. The national benefit of robust economic activity, supported by that debt-fueled demand, might arguably outweigh the individual financial suboptimality for millions of small-scale purchases.
It creates a dependency, a symbiotic relationship. And argument two is even deeper, and it's rooted in one of the most important post-war economic theories, the permanent income hypothesis, or PIH.
Okay, tell us more about this idea of consumption smoothing.
The PIH, which was developed by Milton Friedman, suggests that consumers don't base their current consumption solely on their current annual income. Instead, they try to base their consumption on their expected lifetime income, what he called their permanent income.
Okay, that makes sense.
And since income tends to fluctuate over a lifetime, it's low when you're young, high in middle age, lower in retirement debt, and savings become critical tools for achieving a stable, optimized level of consumption throughout your entire life. This is consumption smoothing.
So the PIH views debt as a utility smoothing tool. How does this apply specifically to consumer debt? Can you give us a concrete example?
Sure. Think about the two largest investments a young person makes: housing and education, both of which involve massive debt.
Right.
A 22-year-old starting their career typically has a relatively low income but very high lifetime potential. To wait until they have the peak income of a 45-year-old to afford their first home or a graduate degree would mean decades of delayed utility.
They'd be missing out on years of living in a home or the higher salary from the degree.
Precisely. Under the PIH, borrowing for a home or a degree now allows them to optimize their lifetime welfare. They get to access crucial assets early and then pay down that debt aggressively during their higher earning periods.
That makes the act of borrowing for education, for example, a really rational, strategic move within a lifetime context. Even though the debt is large and the interest rate might be high, it shifts the conversation away from frivolous spending toward deliberate life strategy.
It does. And the sources remind us that this debt isn't always for a home or education. Consumers also use credit cards to smooth consumption during periods of temporary income loss, like a brief layoff or an unexpected medical expense.
So the debt allows them to maintain their existing standard of living, preventing a jarring dip in their consumption until their income returns.
Exactly. The big question, of course, is how much of this smoothing is used for necessity and how much is used for luxury.
And to bring this fascinating theoretical debate back to the immediate present, the sources point to recent trends, specifically in the US and UK, where personal debt is visibly expanding again. We have concrete data from the U.S. Federal Reserve's 2024 statistics on the U.S. household debt service ratio.
This is a powerful metric. The debt service ratio measures the required principal and interest payments on household debt relative to disposable personal income.
So what did the data show?
The data clearly showed that this ratio had fallen significantly, and it actually hit its lowest point in 2021 since before the 2007 financial crisis.
Wow. So for a brief period following the pandemic-era shutdowns and those injections of savings and stimulus, Americans were, relatively speaking, less burdened by debt payments. But that appears to have been an anomaly.
It was a blip. The data confirms that the ratio has since risen following 2021. This indicates a clear and sustained return to reliance on credit.
And we can interpret this rise through a few different lenses, right?
Oh, absolutely. It could be inflation, driving up the cost of necessities, forcing consumers to lean on credit cards just to maintain their standard of living, or maybe it's pent-up demand for consumption following the pandemic, leading to higher overall borrowing for things like travel and dining out.
Or a combination of both.
Most likely. Whatever the precise mixture of causes, the cycle of credit reliance is definitely increasing again in the world's largest consumer economy. That economic fuel is flowing faster than ever.
Okay, so let's move from the theory and the recent trends to the hard science of finance measurement. How do economists and financial advisors actually gauge the sheer weight and the potential threat of all this debt? We need the metrics that transform these individual experiences into macro-level trends.
Exactly. When we're assessing national solvency and stability, we rely on two critical ratios that allow us to contextualize the sheer volume of borrowing.
The first, which we mentioned earlier, is the big one: the debt-to-GDP ratio.
Right. This ratio, in our context, is the total outstanding private debt of a country's residents. And that includes both corporate and consumer debt, divided by that nation's annual gross domestic product. That's the total value of all goods and services produced in a year. It's really the highest level snapshot of leverage you can get.
So essentially, this tells us how much an entire country's private sector owes, compared to how much the country as a whole makes in 1 year. A ratio over 100% means that the aggregate private debt burden is larger than the nation's entire annual economic output.
Which is a pretty staggering thought. It's a measure of systemic debt burden. But that ratio doesn't perfectly isolate the pressure felt by the average consumer.
Right, because it includes all that corporate debt.
Exactly. So that brings us to the second, more targeted ratio, the consumer leverage ratio, or CLR.
This one is often rushed past, but it's so critical for our deep dive today. How does it differ from debt to GDP?
The CLR is a variant that's designed to drill down specifically into the household sector. It measures the ratio of consumer debt, often excluding mortgages, focusing on things like credit cards, auto loans, personal loans, relative to personal disposable income.
So that's the key. Not GDP, but actual take-home pay.
Yes. The debt-to-GDP ratio gives us the national balance sheet, but the consumer leverage ratio drills down into the average individual's monthly budget pressure.
That makes the distinction really clear. If the debt-to-GDP ratio hints at potential systemic banking risks from over-leverage in the private sector, the CLR tells us how vulnerable the average working person is to economic shocks like inflation or job loss.
Absolutely. You need both to understand the full landscape. One measures the giant pool of debt against national output. The other measures the required payments against the ability of individuals to actually pay those bills. A high CLR suggests an inability for households to weather even minor financial storms without defaulting on their consumption loans.
That is the perfect link for our next point. We've looked at these big systemic macro concepts. Now, let's translate this back to the individual who might be listening and manage their own finances. The question is, if the economy has its high-level benchmarks, what is a safe benchmark for me? And the source material provided the famous 20% rule.
This is a highly practical benchmark used by credit counselors and financial planners all over the world. The source advises that your debt ratio, and that's your total required monthly debt payments, excluding your mortgage versus your monthly disposable income, should be no more than 20% of your take-home pay.
20%. That sounds manageable on paper, but given the interest rates we discussed and just how pervasive credit is, hitting that threshold or blowing past it must be extremely easy, especially for younger generations carrying student loans.
It is a very tight margin, and the primary reason that 20% limit is so crucial is the sheer cost of carrying that debt. This forces us to spend a bit more time on interest rates. What factors fundamentally influence the specific interest rate you get charged on your unsecured consumer debt?
Well, we know the baseline is the central bank's rate, but what moves the needle so dramatically for individual consumers?
The primary factors are really fourfold. First, there's the overarching economic climate, which sets the foundation. Low base rates from central bank mean low overall rates across the board. Second, and this is the most critical one for the individual, is the perceived ability of the customer to repay. This is quantified by your credit score. A higher score translates directly into a lower interest rate because you're deemed less risky.
So if you manage your existing debt responsibly, you're literally rewarded with cheaper access to credit in the future. It's another one of those cycles.
A positive one in this case. Exactly. Third, we have the competitive pressures from other lenders, which can squeeze margins and force rates down, particularly for prime borrowers with great credit.
They're the fourth.
And finally, the inherent structure and security of the credit product. As we've already noted, secured debt carries less risk for the lender and therefore almost always offers a significantly lower rate than unsecured revolving debt like a credit card.
The sources highlight the massive range in these rates. It goes from just 0.25% above the base rate for an extremely low-risk secured loan to, and I'm quoting, well into double figures.
And in some cases, that's an understatement. We're sometimes talking about 400% or 500% APR in the case of certain payday loans. This wide interest rate range is precisely why consumer debt is associated with so much financial risk and why the concept of predatory lending is so contentious within these markets.
The critique we received pointed out that we need to spend more time here because the source material raises this as a really thorny issue. What exactly constitutes predatory lending?
The difficulty lies in drawing the line between selling a high-cost credit product to a high-risk individual, which is a legitimate, if sometimes harsh, market function, and actively exploiting a borrower's vulnerability for profit. The source material refers to this as an ongoing debate, which really reflects the complex legal and ethical ambiguity here.
So if we look at the typical mechanisms that are cited in the materials, what are the characteristics of products that often get labeled as predatory?
They typically target populations that are already financially distressed or maybe lack financial literacy. Common mechanisms include, first, excessive fees and penalties. These fees are often stacked onto the principal, which rapidly increases the overall debt burden, even if the borrower tries to make timely payments.
And second.
Second would be misleading disclosures. So hiding the true annualized cost of the loan behind what seems like a low daily or weekly fee. A consumer might not realize that their small fee loan actually has an APR of 300%.
And what about specific products we discussed earlier, like those car title loans?
Title loans are often central to the predatory lending discussion because they use a necessary asset, a car, as collateral for a small short-term loan. The terms often make repayment extremely difficult, resulting in very high rates of repossession.
And you lose your car, you lose your job.
Right. And another classic predatory mechanism is the balloon payment structure. This is where the loan requires a massive lump sum final payment that the borrower is almost certain to be unable to meet.
Which forces them to do what?
It forces them to refinance the original debt, usually with more added fees. This ensures a debt rollover, which traps the consumer in these continuous fee-generating cycles.
So the debate really focuses on intent and structure. Are these lenders simply providing a market service to people who are deemed too risky for prime credit? Or are they structuring the product specifically to ensure the borrower fails so they can maximize fees through rollovers and repossession?
That's the heart of it. The sources suggest the latter is often the mechanism cited by critics of the industry. It's the difference between high-risk credit and active exploitation. And understanding the scale of interest rates and the methods used in high-cost lending is crucial before we jump into the global data, because these localized individual debt crises are what aggregate up into the staggering national figures we are about to explore.
Okay, now we transition into the global picture, the most data-rich and potentially surprising part of this deep dive. We're using the debt-to-GDP ratio data for a range of countries, relying heavily on the 2016 figures provided in the sources, while acknowledging, as the data itself warns, that it needs updating since 2021.
Right.
But even this historical data shows these dramatic long-term global trends and how reliant different nations are on private borrowing.
What's fascinating here is that the debt-to-GDP ratio, when we apply it to the private sector, so domestic credit to the private sector as a percentage of GDP, is a highly nuanced number. We have to pause and remind you that this private debt figure often includes corporate borrowing alongside consumer borrowing.
Which makes the analysis of the sheer numbers a bit complex.
It does. However, it still serves as a powerful indicator of the overall leverage and financial depth within a country. And the variance is simply staggering. These numbers reflect deeply ingrained differences in national financial systems, regulatory environments, cultural attitudes toward borrowing, and just simple access to formal credit.
So let's start with the extremes. We have to analyze the countries with the highest recorded ratios, where this metric just skyrockets over 175%.
At the absolute top of the 2016 list is Cyprus, with a staggering ratio of 230.1%.
Let's just sit with that for a second. 2.25 times the nation's entire annual economic output is outstanding in private debt.
That level of leverage is immense. When a country registers such an outlier figure, it often suggests a few things based on the context in our sources. First, that it's a relatively small economy with a disproportionately large and possibly aggressive banking sector.
Right, a financial hub.
Exactly. Cyprus, being a major financial hub, likely sees significant cross-border lending that gets booked against its domestic GDP. That could potentially inflate the ratio beyond what pure domestic consumer borrowing would suggest. It points to a highly finance-driven and highly leveraged institutional environment.
And then we have Hong Kong at 203.8%. Again, a small, highly developed, and finance-centric economy. These are nations where the financial sector isn't just big, it essentially is the economy.
And following these two financial centers, we find the massive consumer economies. The United States sits very high at 192.7%. Almost 2 times its GDP is outstanding in private debt. Japan follows at 185.0%, and Switzerland, another stable, wealthy financial hub, at 177.7%.
The common thread here seems to be high development, very sophisticated financial markets, and crucially, a cultural environment where credit is not only widely available but culturally accepted. It's almost necessary to participate fully in economic life.
Now, let's contrast those mega-leveraged economies with the lowest end. We're talking about countries with domestic credit to the private sector under 10% of their GDP.
The data shows Sierra Leone at a minuscule 5.6% and Sudan at 8.9%. I mean, this is a complete reversal of the financialization trend we see in the developed world.
It's the other side of the coin, exactly. When ratios are this low, we interpret it primarily as a signal of a lack of financial inclusion. It suggests that the formal financial system, the one that issues mortgages, credit cards, and corporate loans, is highly restricted, maybe non-existent, or just inaccessible to the vast majority of the population.
So people are operating on a cash or informal market basis.
Pretty much, and while this protects them from the risks of default, it also prevents them from leveraging credit for productive investment, which in turn can hamper economic development and mobility.
So moving back to the more established economies, we see incredible diversity, even within regions like Europe. This really illustrates that wealth alone doesn't dictate a country's debt tolerance.
Absolutely. Consider the major European nations. France is sitting at 97.6%, so a significant but, manageable debt load, roughly equivalent to its annual output. Germany, the economic engine of the continent, is considerably lower at 77.5%.
And this is also linked to that cultural predisposition in Germany towards savings and a general skepticism toward debt. It is sort of deeply ingrained post-war financial conservatism.
That's the common analysis, yes. Now, the UK, by contrast, an economy driven heavily by its financial services sector and known for its robust consumer credit market register, is significantly higher at 135.9%. So there you see that clear split. The Anglo-American financial model tends toward higher leverage than the Franco-German model.
And Spain is at 111.8%, while Ireland, despite its history of massive financial volatility, registered a comparatively low 49.2% in this 2016 snapshot. The data really forces us to look beyond simple geography. National regulatory environments and historic banking practices play a huge role in these outcomes.
They do, and this is where we can step back and look at the trajectory, the sheer pace of change over time. We have these scattered data points from 1960 which illustrate the staggering historical expansion of credit access and reliance.
If we connect this to the bigger picture, the entire second half of the 20th century up to today is basically the story of the financialization of daily life.
It really is. Take the U.S. In 1960, the debt-to-GDP ratio was 70.9%. By 2016, it had nearly tripled to 192.7%.
That is not a marginal change. That is
Yeah.
a fundamental structural transformation of the entire U.S. economy. It's moving from a system where investment and consumption were predominantly financed by savings and cash flow to one that is overwhelmingly fueled by debt.
And Japan shows an equally dramatic, if not more extreme, surge. It went from 56.3% in 1960 to a high 185.0% in 2016. In these two economic giants, the private sector is leveraged 3 times more relative to its economic output than it was 60 years ago.
And we see this expansion across Europe as well. France, which started at a tiny 20.0% in 1960, skyrocketed to 97.6% by 2016. This illustrates so clearly that the shift toward credit reliance wasn't just limited to the countries that led global financial deregulation. It was a systemic, structural change impacting global consumer culture.
This expansion is a direct reflection of those twin forces we discussed earlier in Section 2. First, the acceptance of debt as a necessary tool for consumption smoothing. And second, the economic policy decision to use accessible credit as a continuous engine for domestic demand and production.
Finally, let's look specifically at the rapid growth in emerging economies. This often gives us a snapshot of economies in these hyper-growth cycles where credit access is a relatively new phenomenon.
The case of China is arguably the most globally significant. Its 2016 ratio was 156.7%. For an economy that was historically closed, state-controlled, and relied on internal savings, this figure indicates an absolutely explosive expansion of the private credit market, both corporate and consumer, in a very short period of time.
And that level of leverage in the world's second largest economy, it signals a massive change in consumption habits and carries some serious implications for future global stability.
It does. We also see striking examples in rapidly developing Southeast Asia. Vietnam registered 123.8% and Malaysia 124.0%. These are both examples of economies where rapid industrialization and liberalization have led directly to the widespread adoption of private credit. They're mirroring the historical trajectory of the U.S. and Japan, but it's all happening at a much more accelerated pace.
So what does this all mean? If we synthesize this immense varied data, From the massive leverage of Cyprus to the extreme financial exclusion of Sierra Leone, what's the big takeaway?
The propensity for private debt varies wildly. That is the crucial takeaway. The level of private debt is not simply a reflection of how rich a country is. It reflects deep national differences in financial infrastructure, regulatory openness, and I think most importantly, the cultural norms surrounding borrowing. Some societies have evolved to be built on immediate consumption powered by credit. Others have chosen, or been forced, to maintain a culture of cash and savings.
Okay, let's bring this fascinating and highly detailed deep dive to a close by summarizing the key takeaways. Consumer debt is a critical, complex measure in macroeconomics, precisely because it represents money used for non-appreciating consumption. Everything from that non-essential big-screen TV purchase to necessary student loans.
And this consumption-focused debt often carries very high interest rates and a correspondingly high risk of personal financial distress. That's what drives the demand for specialized support like credit counseling.
But crucially, we explored the necessary balance to the traditional view that debt is always suboptimal. The permanent income hypothesis provides a strong justification for strategic borrowing, that idea of consumption smoothing, where individuals optimize their lifetime welfare by using debt to access major needs early in life.
And at the macroeconomic level, easy consumer credit is cited as a vital mechanism for constantly increasing demand, acting as a reliable fuel for robust domestic production.
And the data confirms this dependency is only growing, particularly in the developed world, with the U.S. household debt service ratio climbing again since that 2021 low point.
My final thought on the data is that we can't assume global convergence. While debt is rising across the board, the immense gap between countries, Cyprus at 230.1% versus a nation like Albania at a much lower 34.5%, it shows there is no single global rule or uniform tolerance level for private debt.
So each economy develops its own relationship with credit.
Exactly, based on deep-seated historical, cultural, and regulatory choices. This variability is really the heart of the risk and the heart of the story.
And that variability gives us our final provocative thought for you, the learner. We saw that related topics in your source material included consumerism and consumer credit risk. So given everything we've discussed about the increasing reliance on borrowing to maintain a certain standard of living, how does the pervasive cultural drive for immediate consumption, the core tenet of modern consumerism, ultimately shape and potentially threaten the stability of our increasingly leveraged national economies? Is the drive to buy now fundamentally sustainable in the long term? We leave you to ponder that vital connection.
Thank you for providing the material for this deep dive into the global consumer debt landscape.
It was a pleasure as always. We'll catch you next time.